In today's episode, I'll talk about two stories. In the first story, I'll talk about a very comprehensive analysis of the entire Indian economy. And in the second story of the day, I'll talk about government spending, about how well the government spends its money, and what it really means for people like you and for me. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Monday, the 24th of February. Let's begin with the first story. Look, India had a remarkably strong performance in the last financial year, which is FY 2024, when it clocked a GDP growth rate of 8.2%. Now, this happened at a time when the rest of the world seemed to be in disarray. So, India stood out as a bright spot globally. And then, as we entered this financial year, the storyline became a little less rosy. The first quarter saw year-on-year GDP growth dip to 6.7%, and in the second quarter, it tumbled even further to 5.4%. Now, these dips in growth bring up a debate. Is this just a temporary slowdown, or could this very well be a sign of deeper economic difficulties for us? Now, different analysts have offered widely varying estimates for how the economy might have performed in the quarter which followed it. Now, Motilal Oswal, for instance, said that growth for that quarter could be around 5.7%. SBI Research provided a slightly higher range of 6.2 to 6.3%. ICRA thought it could go up to 6.4%, while Bank of Baroda thought it would be at 6.6%. Now, because these numbers are all over the place, many observers, including us, are just waiting for the official data before drawing any firm conclusion. But that said, GDP growth alone might not fully capture what is truly happening here. It is just one number, and it can hide problems or bright spots in specific areas of the economy. Sometimes focusing on GDP without looking deeper can lead to an oversimplified impression as well. And in order to get a complete overview here, it might help to look at a variety of indicators which show how different parts of the economy are behaving. Now, the economy, as you would imagine, are made up of multiple moving parts. And sometimes these moving parts move in opposite directions to each other. Now, these things can get very messy, but the good part is that the messiness is also where you find some very valuable insights. So in this story today, let's go through several lenses that can help us understand what is exactly going on here. First, let's start by looking at general indicators of overall economic activity. See, several organizations regularly combine different data points into indexes that provide a single broad-based figure for economic performance. These data points might include trends in manufacturing, services, retail activity, and much more. Now, over the last few months, many of these indexes, such as those tracked by the RBI or the Reserve Bank of India and by ICICI in its monthly chart book, show that the economy has neither been booming nor has been shrinking significantly. It has actually been relatively stable. Now, some research units like SBI Research even argue that the economy has been accelerating in the recent few months. One more interesting approach here is to simply ask people how they feel about the economy, which is what the RBI does through the consumer confidence surveys. Now, based on these surveys, many Indians seem to have a hopeful outlook about the future, but they are not very happy with their present situation. Now, this split between current and future confidence suggests that people might be going through challenging circumstances right now, but they are expecting things to improve down the road. Also, if you want clues about actual physical movement of goods and people, we can actually look at how much stuff is being transported around the country and how many vehicles are on the roads. One such measure is the number of e-way bills that are created under India's GST system whenever large consignments of goods are moved. One more measure here is the money that is collected through highway tolls. Now, both of these numbers saw a dip in the month of November, and that's possible because of a post-Diwali cooldown in business and transport activities. But they also picked up noticeably in December and January, and that is good news for sure. According to RBI's State of the Economy report, e-way bills in January posted more than 25% year-on-year growth, which indicates a strong rebound in goods movement. Also, similarly, when we look at how Indians are paying each other, either through UPI or IMPS payments, there was a significant fall in year-on-year growth in the month of November. And this mirrors the dip that we saw in e-way bills, which suggests a quieter period after Diwali. But that said, while e-way bills and toll collections bounced back strongly after January, UPI and IMPS payments growth seems to be more muted in comparison. Data from Bank of Baroda's monthly chart book also shows that both UPI and IMPS did grow in the month of January on a year-on-year basis, but not as dramatically as the movement of goods measured by e-way bills or tolls. Moving on, since almost everything runs on energy, power consumption is one more helpful gauge of whether industries, offices, and households are operating at full steam. Now, power use was quite weak in the second quarter of this financial year, but according to Bank of Baroda's monthly chart book, it inched up in the third quarter, even if not by a huge margin. You can see a very similar story in petrol and diesel consumption as well. Petrol consumption, which primarily reflects smaller vehicles, saw year on year declines for much of the second quarter, but then grew by 3.1% in January, as noted in the RBI State of the Economy report. Diesel consumption, which is often used for trucking, bus transport, and the entire agriculture sector, has also recovered. And these signs point to at least some sections of the economy regaining momentum. And of course, the real heart of an economy is the people in it, and one of the most critical questions here is, how are ordinary Indians faring? And this naturally branches into other questions. First, are people buying enough goods and services? Second, are enough jobs being created in our population? And third, do individuals have sufficient access to credit? See, for consumption, people's willingness to spend is often visible through big ticket purchases like vehicles. Most people do not really buy a car or a two-wheeler unless they are fairly confident in their income and job security. During most of the last quarter, vehicle sales actually declined, which might have signaled that people were anxious about their future. But that said, the numbers did rebound dramatically in the month of January, according to RBI's State of the Economy report once again, which suggests that either a return of confidence was there or a seasonal boost was prevalent during this time. But for other sort of purchases, the data gives us a bit of a mixed picture. Sales of consumer durables, which are items like appliances, televisions, and other products that last a long time, saw a noteworthy increase over the last quarter or so. And that might mean that at least a portion of the population is feeling good enough to invest in longer term household items. Meanwhile, the sales of non-durables, which are products like soap, shampoo, snacks, etc., remained fairly stagnant. Now, ICICI's monthly chart book highlights these very diverging trends. This mirrors the sales numbers that were reported by many large FMCG companies, which described subdued demand in rural markets. But all that said and done, the fact of the matter is, before consumers can even think of spend, they need to earn money, right? India's organized sector, which generally includes formal businesses which are registered with the government, added jobs in both services and manufacturing during the last few months. In fact, organized employment reportedly grew at one of the fastest rates since the formal data collection began in December 2023, according to the RBI. But the thing is, this is only one part of the story. Much of India's workforce is still in the unorganized sector, which is not always rightly captured by official tallies. And when we account for the entire workforce overall, the national unemployment rate sticks stubbornly at around 8% based on ICICI's monthly chart book. But diving deeper, urban and rural labor markets seem to be on fairly different paths. In January, workforce participation, which is the share of people in the population who are either working or seeking work, rose in cities, but it fell in the rural areas. And at the same time, many people in rural areas have been turning to the government's Manrega job scheme. ICICI's data shows that the number of people who are resorting to Manrega jumped by 14% year on year, though the program itself offered fewer jobs than it did before. And this points to the difficulties that rural areas might be facing, even as some parts of the overall economy manage to stabilize or improve. Access to credit is also vital for regular people. See, until recently, the Reserve Bank of India was concerned that lending to individual borrowers was growing too fast. The RBI even made it more capital intensive for banks to issue such loans, which was hoped at slowing down the pace. And that strategy seems to have worked now, because as Bank of Baroda's chart book shows, retail lending growth decelerated sharply after June last year and has stayed relatively slow for more than half a year now. Credit card spending followed the same pattern here, though not as dramatically. And this slowdown extends to housing loans as well, which according to data saw their rate of growth drop significantly in the middle of last year. Now, these internal dynamics of spending, which is jobs and credit, are tied to how the rupee behaves on global currency markets. Over the last few months, the rupee has weakened considerably, hitting the lowest level ever against the US dollar. Now, a currency's value is affected by how many people want to buy rupees relative to how many rupees Indian wants to exchange for foreign currencies in order to buy imports or invest abroad. A part of the reason why rupee feels a pressure right now is that India's merchandise exports, which include goods like machinery, textiles, and petroleum products, declined in the month of January. The RBI State of the Economy report mentions that exports of petroleum products in particular fell sharply, possibly because of sanctions that the US placed on Russian oil, which may have affected India's re-export of refined products. But while exports went down, merchandise imports rose by 10.3% on a year-on-year basis. And this gap widened the trade deficit to 23 billion US dollars in January, up from 16.6 billion US dollars in the same month a year earlier. And this is, of course, a part of a bigger story here. For most of this financial year, India's trade deficit has been larger than it was in the previous year. Services exports help on the other side of the equation because India is a big exporter of IT and other services, and these bring money into our country. In January, both services exports and imports grew by 16.5% and 13.8% respectively. And since India exports more services than it imports, that created the largest services surplus that we ever recorded in one single month. But that said, this positive services surplus by itself does not fully compensate for the widened merchandise trade deficit. Moving on, investment flows, which are also known as the capital account, are one more part of the puzzle that are influencing the currency. While India did receive more FDI or foreign direct investment this year than it did last year, the increase was cancelled out by the amount of money that was got in from India or by investments that Indian companies have made abroad. As a result of this, net FDI for this financial year turned out to be negligible. Also, things look even worse when we talk about portfolio investments such as those in stocks and bonds. See, many foreign investors have been pulling out money from the Indian markets at a pace that has not been seen in many years, according to RBI's data. And this outflow means that there is less foreign demand for rupees. Meanwhile, to try and defend the rupee's value, the RBI has been using some of its foreign exchange reserves, which have diminished considerably over these months. So with all of this happening, if India does manage to show stronger GDP growth in the December quarter, the natural question is, where might this growth be coming from? Many analysts who predict stronger growth point to three main factors here. First, they argue that government capex, which is capital expenditure, has been making a comeback. Now, capital expenditure for your context is when the government builds roads, railways, and other infrastructure that can boost long-term economic activity. Second, they think manufacturing has picked up once again after a low period. And third, they see positive signs in agriculture, particularly because of last season's harvest and good water availability for the next season. Also, government spending can make a significant impact on the economy. The government had been spending heavily in recent years to spark growth, but this trend cooled off earlier this financial year, possibly because of the Lok Sabha being reshuffled and priorities shifting in many ways. But that said, there was a clear spike in spending towards the end of the calendar year. According to the RBI, the government almost doubled its capital expenditure year on year in the month of December. Over the final quarter as a whole though, central government capex increased only by around 1.7%, while state government capex, which is also as important, declined noticeably. SBI research points out that the government showed more enthusiasm for revenue spending both at the central and state levels rather than on new capital projects. Moving on, private businesses are one more crucial player here. See, for a truly robust economy, we expect most large-scale capital spending to come from private enterprises rather than the government. Unfortunately, private investment has been lukewarm for quite some time now. According to the RBI State of the Economy report, there was no clear upward trend in private companies' willingness to invest in new projects over the last quarter. And if we look back to the second quarter, private investment actually grew more slowly than it did 1 year before, as shown in the Bank of Baroda's monthly chart book. Now, there is a possibility that businesses postponed big investments because they wanted to see clearer signs about how the economy was shaping up. But on a brighter note, corporate earnings, which are measured by EBITDA, returned to positive territory for the first time this financial year, growing 5.2% year on year in the last quarter. Now, this modest improvement may give businesses more confidence to invest in the near future. Also, one more positive here is that Indian companies' imports of capital goods grew by 7.6% year on year in December after a brief dip. And as for manufacturing, there are indicators that the industry has been on an upward trend for a couple of months now. Several reports, such as the ICICI's monthly chart book, show that industrial activity has been rising since the start of last quarter. Also, India's manufacturing PMI, which measures how confident manufacturers feel about orders and production, has been inching up as well. The Index of Industrial Production, or IIP, which is a well known measure of manufacturing output, has been suppressed in the second quarter. But that said, it rebounded to around 5% year on year growth in November, which is a 6-month high, before easing back to 3.2% in the month of December, according to data from Trading Economics. Now, these numbers suggest that manufacturing is not really booming, but it is at least doing better than what it was doing a few months ago. Moving on, agriculture also plays a major role in India's economy, particularly for rural incomes. Now, this winter, the data shows that slightly more land has been sown with crops than it was last year, which is an increase of about 1.7% year over year, although farmers have grown fewer oilseeds and coarse cereals as compared to before. Interestingly, the use of fertilizers has jumped up by more than 10% year on year based on ICICI's numbers. This could mean that while the overall area planted grew only a little bit, farmers are now intensifying the cultivation on the land they do farm. Another piece of good news is that the previous monsoon season gave our country a lot of decent rainfall, and that is why reservoirs in many parts of India have more water stored than what they did at the same point last year. And that means there should be enough water for irrigation in the months ahead, which is very helpful when the next cropping season begins. So, after taking in all of these details, the reality that we find is fairly very complicated. The official GDP number for the most recent quarter will be announced soon, and it may land anywhere in the range that analysts have suggested, or even beyond that, maybe. But that single number honestly cannot really capture the messy reality that we have underneath. The economy is an interconnected system where different sectors can be doing well or poorly at the same time. For example, retail lending can slow down even as toll collections pick up. Power consumption can dip in one quarter and then rise in one more quarter. Trade deficits can widen even when services surplus expands to a record level. So all of these movements, whether in consumption patterns, job numbers, or investment flows, happen together and they all shape the overall direction of our economy. Sometimes they reinforce each other and sometimes they cancel each other out. So on that note, let's move on to the second story of the day. In this story, I'll talk about how the RBI recently examined how a government should create development in a country. And one of the most common answers that they found is through public spending. And that's exactly what we'll be talking about here. See, governments can use their budgets to build roads, provide education, ensure healthcare, and also invest in industries. And all of this, in many ways, is public spending. But the thing is, not all public spending is equally effective. Sometimes funds can slip away without creating any visible benefits, especially if the government's plans are poorly designed or if the money is not used carefully. The RBI's report looks at how well India has spent its public money from the year 1991 all the way to 2025. In very simple words, it basically tries to measure how much of the government's money went into building infrastructure, creating social benefits and healthcare and education, and also boosting areas like agriculture, skill building, and poverty reduction. It also checks how much of the budget was used just to repay old debts or to cover administrative costs. And the idea of doing this is to understand if the government is spending enough on areas that truly help an economy grow and whether it is doing so in a financially responsible way. So in order to understand this in better detail, let us first start with the fact that public spending has many parts. There is capital investment, which refers to infrastructure projects like highways, railways, ports, and other power grids, etc. These allow people and businesses to move around more easily, trade goods faster, and also set up new factories, which in turn can obviously create jobs. Now, over time, the returns from these big projects can pay off because they help the economy become more efficient. Another aspect of public spending is on public goods. These include healthcare, education, security, and access to clean water. And these are services that benefit every person in society, even if they do not directly make money. Then there is development spending, which involves efforts like poverty reduction, supporting farmers, encouraging new entrepreneurs, and also improving people's skills. And these areas usually do not get enough attention if they are left solely to the private market, so the government steps in to make sure no group is left behind. Now see, a major problem arises if a government overspends. This can lead to high deficits, and this situation can also disturb the entire economy. It also increases debt levels and interest payments, reduces the country's savings, and can also create inflation, all of which can make investors and citizens less confident in the government. And when that happens, a lot of tax money has to be spent on paying back old debts instead of building new schools or new roads. So, a healthy level of fiscal discipline is definitely needed in order to keep the economy stable and also to ensure that there is always enough money for future development projects. Now, the RBI studied India's public spending habits across 6 different phases. The first phase began in 1991, right after India liberalized its economy. See, the government's main goal at that time was to bring stability after a serious balance of payments crisis. While doors to foreign investments opened, the focus on controlling inflation and cutting deficits meant that there was less attention on building new roads, power lines, or any major development schemes. At the same time, the government had to be very cautious to not cut spending too heavily because it still needed to keep supporting social programs and infrastructure to some extent. The second phase was from 1996 to 2003, and this saw India dealing with rising fiscal deficits. The government was spending a lot on interest payments on old borrowings, and the Fifth Pay Commission's decision to raise government salaries added to the financial burden. And this made it very hard to spend freely on major projects. States also felt the strain here, and they found it difficult to invest in infrastructure. And these problems showed India needed better fiscal rules, which led to discussions about the Fiscal Responsibility and Budget Management, or the FRBM Act, which aimed to keep deficits in check and also improve the quality of government spending. Then was the third phase, which was from 2003 to 2008, and that was a bit of a bright period. By this time, the FRBM Act was implemented, and this helped control deficits. The economy was booming, so the government also earned more from taxes and they could invest more in infrastructure as a result of it. Roads, power plants, and urban projects all got a push during that time. And with the debt situation improving, interest payments also took up a smaller share of the government's budgets, which made more room for programs aimed at development. Now, some well-known schemes like the National Rural Employment Guarantee Act or the NREGA also came into existence around that particular time, which targeted rural unemployment and development. And even though the economy grew and some sections of the population got richer because of all of this, many rural parts actually did not share equally in the gains. So the benefits were not really evenly distributed, to be honest. Then was the fourth phase, which was from 2008 to 2013, and this brought in some new challenges. The global financial crisis hit, and governments worldwide decided to step in with extra spending to prevent a deep recession. India cut taxes, introduced stimulus packages, and poured money into infrastructure in order to keep economic growth alive. And while it prevented a severe downturn, what it also did is that it increased the deficit and the overall debt levels. The extra money in circulation also drove up prices for goods and services. And by the end of this period, it was very clear that the government needed to bring spending back under control to keep the economy stable. Then came the fifth phase between 2013 and 2020, and this included a series of important policy changes. One of the biggest was the suggestion by the 14th Financial Commission to give states a larger share of central government revenue. So states went from having access to 32% of central funds to 42% now, and this gave them an even bigger role in deciding how to spend on infrastructure, health, and education. But that said, the change also came with some complications. The GST, or the Goods and Service Tax, was introduced in 2017 to simplify the tax system, and it helped boost revenue collection over time. But there were initial hiccups to it. Some states had difficulty raising enough money in the first few years of GST, which affected their ability to keep up with development spending. Although infrastructure remained a key focus, the government had to manage within the limits of its new fiscal structure. And then came the sixth phase, which covers 2020 to 2025, which started in the middle of the COVID-19 pandemic. Now see, of course, the pandemic forced all governments to spend heavily on healthcare measures, direct cash transfers, and other relief efforts. And as a result of that, the government's debt rose pretty sharply, and interest payments took an even bigger bite out of public funds. And once the worst of the pandemic was over, the government shifted gears to an infrastructure-led recovery. And this meant massive investments in road, transport, and digital infrastructure in an attempt to boost the economy, create jobs, and address the slowdown. Now, this approach also brought higher borrowing, which sparked debates on whether such elevated spending can be sustained without creating debt problems down the road. But that said, across all of these phases, a few important lessons stand out. It is important to use public money in ways that improve productivity in the long run, like funding infrastructure and investing in people's health and education. Borrowing a lot might help in the short term for sure, but if debts become too high, large chunks of future budgets will be spent on just paying off loans. And that, of course, leaves less money for development projects. At the same time, if the government manages its finances well and keeps its deficit under control, it can build trust among investors, which further strengthens the economy. So, overall, the RBI's report suggests that India's public spending has swung between the need for fiscal discipline and the push for growth. When spending is well planned and carefully managed, it can speed up development for sure, it can create more jobs, and also bring about stronger economic growth overall. But that said, when spending is rushed or done without keeping an eye on deficits, it can lead to debt troubles and inflation. So, balancing these competing needs, which is investing in the right areas while still keeping the books in order, remains to be the main challenge for India. That brings us to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India's external commercial borrowings went up to $15.6 billion between April and December 2024. That is almost 3 times higher than before. This rise happened because global interest rates fell. During the same period, total disbursements of such loans reached $36.6 billion, up from $26.1 billion a year earlier. Repayments stood at $21 billion. Second, the Reserve Bank of India's open market operation auction received bids worth 1.87 lakh crore rupees, which is much more than the 40,000 crore rupees on offer. This shows there is still a liquidity deficit of around 1.77 lakh crore rupees. The central bank has purchased 1 lakh crore rupees worth of securities in total, and most of this, which is around 58,875 crore rupees, was bought through screen-based auctions, and 39,000 crore rupees came from the secondary market. In order to manage this shortfall, the RBI injected 1.33 lakh crore rupees through overnight variable rate repo auctions and will add one more 75,000 crore rupee with a 14-day repo. Third, Indian refiners cancelled orders for 70,000 metric tons of crude palm oil scheduled for March to June. This happened because Malaysian palm oil prices went up by 11% in a month, pushing costs to $1,210 per ton. In January, India's palm oil imports fell by 45% to 275,000 metric tons, and that is the lowest figure in almost 14 years. Refiners are instead choosing to import cheaper soya oil from Argentina and Brazil. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it. I'm your host Anurag Bansal, who's signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.